Welcome to Talk Tickers, the briefing that distills earnings calls into essential insights. We aim to give you the complete picture, without all the information overload.
That's the goal.
Today, we're dissecting Movado Group's second quarter fiscal year 2026 earnings call. This one took place pre-market, August 28th, 2025.
It was a really fascinating one, wasn't it?
It really was. You had this significant macroeconomic headwind, a huge one, frankly, that could have really shaken up the whole Swiss watch industry.
Right.
But it met head on with Movado's incredibly strong operational resilience.
Yeah, and the market reaction was, well, a bit of a head scratcher at first, a dip, then a rally.
Exactly. So there's a deeper story there, and that's what we're going to unpack for you today. Let's jump right into those headline numbers first, because, on the surface, they look like a bit of a mixed bag. Could have easily put investors off.
Mm-hmm.
Movado Group reported robust revenue, $161.8 million, comfortably beat the analyst consensus there. But adjusted earnings per share came in at $7.23, and that notably fell short of expectations.
Right, that was the miss everyone saw initially, about 28 cents short, or 25.8%.
Yet despite that earnings miss, the stock saw a pretty significant rebound throughout the trading day.
Yeah.
That's the puzzle we need to solve. How does a company miss on earnings but still, instill that kind of confidence in the market?
And that really is the core insight, I think. It wasn't just what Movado reported, but how they presented it. And the underlying strength that let investors sort of look past that initial earnings stumble.
Okay.
The immediate takeaway for the market, and management really hammered this home, was Movado's incredibly strong balance sheet. We're talking over $180 million in cash.
Wow.
And crucially, absolutely zero debt.
Zero debt in this environment.
Exactly. Think about it. You've got this looming 39% tariff on Swiss imports hanging over everything. Yeah. A cash fortress like that, it's not just nice to have, it's a strategic lifeline. Gives them immense flexibility.
But lets them navigate the uncertainty.
Yep. Combine that with the foresight they showed, which we'll get into, and you start to see why the market kind of pivoted its view.
Okay, so it's that financial strength meeting strategic agility. Let's dig into the actual financial performance then, because that revenue beat, that was quite impressive.
It was.
What fueled that top line growth, especially when, as you mentioned, the Movado brand itself saw a bit of a decline?
Absolutely. So that $161.8 million in revenue, that's a 3.1% increase year over year, or 1.4% on a constant currency basis. Clearly beat the consensus.
Okay.
And the main driver, it was the company's licensed brands. They saw impressive growth, 9.5% or 6.5% constant currency.
That's huge for licensed.
It is. And that's a crucial point because it shows diversification. They also had strong performance in their company-owned stores.
Right.
Now, you're right. The Movado brand itself did experience a 5.6% sales decline. Management expressed confidence in their strategy to get it back to growth. But the licensed brands are clearly the engine right now. They're pulling a lot of weight.
That's an interesting split, isn't it? Licensed brands are flying, but the flagship Movado brand is pulling back a bit. Does that suggest a shift in strategy maybe, or just different challenges for the core brand?
Could be a bit of both.
And how did all this complexity then show up on the bottom line, especially with that earnings miss we talked about?
Yeah, it's definitely a nuanced picture. And that earnings miss, $0.23 adjusted EPS versus a $0.31 consensus. Well, that 25.8% miss is certainly not ideal on paper.
Yeah.
But the story gets more complex and maybe more impressive when you look at the gross margin.
Okay.
It held strong at 54.1%. That's only a slight decrease, just 20 basis points year over year.
Only 20 basis points with everything going on.
Exactly. What's truly remarkable is that they achieved this despite a significant approximate 130 basis point headwind just from the new U.S. tariffs and unfavorable foreign exchange rates.
Wait, 130 basis points just from tariffs and FX? That's a massive hit.
It's a substantial punch, yeah. And how on earth did they manage to practically offset that and keep gross margins so steady? It's almost counterintuitive.
So how did they do it?
Well, this negative impact was largely mitigated by a favorable channel and product mix. It just shows really effective management and the strategic flexibility they have within their portfolio.
That operational skill, keeping margins stable against those headwinds, that's really impressive. You have to give them credit there.
Absolutely.
But, okay, while the gross margin held up, the earnings did miss. Is there a risk that some of these mitigation efforts, like the mix shift, are maybe short-term fixes? Or could they fundamentally reshape Movado's cost structure and long-term profitability especially if these tariffs stick around.
That's the critical question for any investor, right? Are these band-aids or are they fundamental changes?
Yeah.
When we look at operating income, it gives us some clues. Adjusted operating income actually more than doubled, increased to $7.0 million from $2.6 million in the prior year.
Doubled.
Well, it was driven by the higher revenue and the improved gross profit we just talked about, but also by a $2.0 million decrease in operating expenses.
Ah, okay. Cutting costs.
Right. Specifically, a strategic reduction in marketing expenses. And this was even with a $2.2 million impact from unmitigated U.S. tariff expenses hitting the P&L.
So they cut marketing to offset some tariff pain.
It looks like it, yeah. It suggests a blend of both, short-term tactical adjustments like optimizing marketing spend and maybe some more fundamental shifts in cost control.
And that strong balance sheet comes back into play here, I imagine.
Exactly. That $180 million plus in cash and no debt isn't just a footnote. It means they have the firepower to invest in new strategies, maybe acquire smaller brands, or just weather a prolonged tariff fight without needing expensive debt. That's a massive competitive advantage right now.
That strong cash position certainly buys them a lot of flexibility. And they also continued returning capital to shareholders, right? Which kind of speaks to that underlying confidence.
They did. The board declared a $1.35 quarterly dividend that's payable September 22nd, 2025.
Solid dividend.
And Movado repurchased approximately 100,000 shares year to date. They still have $48.4 million left under their share repurchase program. So yeah, they're not just hoarding cash, they're actively deploying it for shareholder value.
Okay, now let's pivot to where it gets really interesting and where that big macro headwind truly comes into focus.
The tariffs.
The tariffs. The most significant factor impacting Movado, and honestly the broader Swiss watch industry, is this newly imposed 39% U.S. tariff on Swiss imports. It became effective August 7th, 2025.
Yeah, 39%. That's not a minor tweak.
Not at all. It's a substantial policy change.
Right.
Creates considerable uncertainty. How does a company even begin to mitigate a blow like that?
That is the critical question. And this is where Movado's management showed, I think, remarkable foresight.
How so?
During Q2, before the tariff actually kicked in, they strategically built up a strong inventory position of their Swiss-made watches right here in the United States.
They front-loaded inventory.
No, essentially, yes. They front-loaded a significant chunk of their expected holiday inventory to preempt the tariff impact. It effectively gives them crucial breathing room to figure out other long-term strategies without immediate panic.
It's like seeing the storm coming and stocking the bunker before it hits.
Exactly like that. A proactive move, crucial for mitigating the immediate impacts. But beyond just inventory, they are actively pursuing other levers too.
Like what?
Strategic pricing actions, they said many of those actually became effective back on July 1st. They're optimizing the product mix, controlling operating expenses, and negotiating with suppliers, hitting it from multiple angles.
That's a textbook example of proactive risk management, that inventory build.
Yeah.
But beyond these tariff-specific actions, what about broader cost controls? Especially thinking about those prior issues they had at the Dubai branch. Are they tightening the belt overall?
Yeah, to further counter these pressures and just generally streamline things, the company is targeting about $10 million in annualized savings. That's from cost reduction actions they put in place late last year.
Okay, $10 million annualized.
In Q2, they took a $7.9 million charge for those cost savings actions. And interestingly, they also had $2.1 million in investigation-related professional fees.
Still related to the Dubai situation.
That seems likely, yeah. Tied to the ongoing internal controls remediation after that April restatement because of the misconduct there.
Are those costs mostly behind them now?
Management stated that the restructuring charges are predominantly done. They did mention some potential Lagarde expenses remaining for that Middle East event.
Lagarde expenses, so like the final straggling costs from wrapping that up.
Precisely. Think of them as the lingering tail end costs, final invoices, administrative wrap-ups from that specific event, not indicative of new significant restructuring or ongoing operational issues.
Got it.
Overall, those charges are expected to reduce significantly going forward, which is definitely a positive sign for future profitability.
Okay, so Movado is expertly navigating these external headwinds. Seems like it.
Yeah.
But what about internal growth drivers? What's the path forward beyond just mitigating risks? Are they playing offense too?
Oh, definitely. What's fascinating here is the clear emphasis on specific growth areas, Shows they're not just playing defense. As we discussed, licensed brands are leading the charge.
Right.
But there's also notable strength in women's watches. They mentioned new iconic bangle and mini quest models specifically.
Women's watches are strong.
Yeah, and management highlighted a really interesting trend. Mini watches, those typically say 23 to 28 millimeters, and even micro watches, they're bringing young women back into the watch category.
Oh, interesting. Why is that?
Well, it seems it's not just a passing fad, it's amplified by social media.
That's
They often see these smaller watches layered with jewelry, kind of tapping into a broader fashion statement.
Makes sense.
And men's jewelry is also performing strongly for them.
That's a brilliant insight into how they're adapting to, evolving consumer trends, particularly reaching younger demographics. How are they reaching these customers then? Is digital still a strong channel?
Absolutely. Digital remains a key focus. Their own e-commerce site saw 6% growth. And they're seeing strong trends with their digital partners globally. It's just a testament to that ongoing shift in retail.
Sure.
And here's another interesting point. Even the main Movado brand, despite that overall Q2 sales decline we mentioned, its sell-through actually returned to growth in the department store channel.
Sell-through, not sell-in. That's an important distinction.
It's crucial for investors, yeah. Sell-in is what Movado ships to retailers. Sell-through is what customers actually buy from the stores.
So customers are actually buying more Movado watches in department stores now.
Yeah, that's what the data suggests, yeah. Due to expanded point-of-sale coverage and new display installations, it's a much stronger signal of actual consumer appetite picking up for the core brand in that channel.
So even with the overall dip, there's underlying demand strength there. That's a good sign. What's on the horizon then for the second half? Marketing, new products to capitalize on this.
Yeah, for the second half, Movado's planning some exciting new product introductions and big marketing campaigns featuring prominent celebrity icons.
Oh, yeah.
Across both owned and licensed brands, they mention names like Ludacris, Jessica Alba, Julianne Moore, Christian McCaffrey, Tyrese Halliburton. Big names.
Wow, quite a list.
Definitely leaning into star power. New products debuting this fall include the Museum Imperial and Heritage 1917, and also women's versions of the Museum Bengal collection and those Imperial and Heritage lines.
So tying the new products to the celebrity push.
Exactly. They're clearly focusing heavily on digital-first content, and these endorsements to drive interest connect with those younger, trend-driven consumers, especially heading into the holidays.
Okay, so given all this, the operational agility, the proactive tariff work, these growth initiatives, a critical piece of news from the call was their decision to withdraw the full-year fiscal 2026 outlook.
Yeah, that was big news.
Why pull guidance? Especially after beating on revenue, that kind of move often rattles investors.
It can, yeah. But management was very, very explicit about this. They stated the decision was solely due to the significant uncertainty surrounding that newly imposed 39% U.S. tariff on Swiss imports.
So only the tariff uncertainty.
That's what they emphasized. It reflects genuine macroeconomic and policy uncertainty, not any internal execution issues. It's like trying to forecast the weather accurately during a hurricane. It's just too volatile to make a solid prediction right now.
Okay, that makes sense. So what do they say about the near-term outlook?
For the near term, they expect holiday sell-in, continued tariff mitigation efforts, pricing, mix, sourcing, inventory management, and just general watch demand normalization to drive performance in the second half.
And they're hoping for some relief on the tariff front.
They are. They mentioned they're hopeful for an agreement between the U.S. and Switzerland to lower those tariff rates in the coming months. And by year-end, they expect their inventories to align back with historical levels, meaning that strategic inventory build will have served its purpose.
So Movado Group's Q2 call really paints this picture of a company skillfully navigating some pretty significant external pressures using a pragmatic, proactive strategy.
I think that's fair.
The revenue beat, the disciplined gross margin management, especially considering the tariffs and FX hits, those are strong, positive signals. Shows impressive operational agility.
Yeah, the margin performance was standout.
And the decision to withdraw guidance, while, initially unsettling, it does seem like a realistic response to a highly uncertain trade environment rather than signaling deeper internal problems.
Seems that way.
For any investor watching Movado, though, the critical question has to be, how sustainable are these mitigation strategies? Are they just buying time, or are they genuinely setting the company up for a new, more resilient operating model for the long haul?
That's the key uncertainty now. If we connect this to the bigger picture, though, The market's positive reaction after the call rallying significantly despite that pre-market dip, it indicates investors are recognizing the underlying strength.
The cash, the dividend.
Exactly. The strong cash position, the ongoing dividend, and management's proactive approach to the tariffs. That cash isn't just a footnote. It means they have firepower to invest, maybe acquire, or just weather a prolonged fight without debt. It's a massive competitive advantage right now.
Right.
And the emphasis on licensed brand strength, the appeal of women's watches, men's jewelry, the robust digital growth, those all point to internal levers the company is effectively pulling to drive growth and diversify risk away from just Swiss-made Movado watches.
So what are the key catalysts to watch going forward?
Definitely any policy developments on those U.S.-Switzerland tariffs. That's number one. Then the success of the upcoming holiday sell-through and continued progress on cost savings and fixing those internal controls.
And that strategic inventory build.
Yeah, that suggests a foresight that could buffer the immediate impacts, giving them crucial time to adjust their long-term strategy. It positions Movado as, a resilient player in a volatile market, but one still very much subject to those external policy shifts.
Let's put on our speculative hats for a moment. This whole tariff situation has created a huge amount of uncertainty.
For sure.
If you were, say, a hedge fund analyst looking at Movado right now, and you believed these tariffs were maybe here to stay for a while, what kind of outrageous but plausible trade might you pitch? This is not financial advice segment, by the way. Purely theoretical discussion.
Okay, purely theoretical. Given Movado's strong balance sheet, that proactive Swiss inventory build, and its strong licensed brand portfolio, which is inherently less exposed to Swiss imports, here's a thought. We'll call it the Swiss cheese spread.
Okay, intriguing name. What's the play?
First leg, long Movado Group, MOV, call options. Longer dated, slightly out of the money calls. Because the market has already priced in a lot of this tariff uncertainty, hence the guidance withdrawal. But Movado has cash, cost savings plans, mitigation efforts. If they successfully navigate this through pricing, sourcing changes, maybe pivoting some lines away from Swiss components or manufacturing the market, could re-rate the stock pretty quickly, especially once they can reinstate guidance.
So you're betting on their adaptability and upside potential if things resolve or they manage well?
Exactly. This play benefits from any positive news on mitigation or eventually easing trade tensions. It could unlock significant upside from the current sort of suppressed valuation. It's a bet on their resilience.
That's a bold play on their strength.
Yeah.
What's the other side of this Swiss cheese spread then? The hedge.
Right. To hedge against a scenario where the tariff situation gets really intractable and hits the whole industry hard, and to leverage Movado's relatively diversified portfolio, we'd look to short a European luxury watch pure play.
Okay, which kind?
We'd target one that's highly exposed to Swiss manufacturing for basically its entire product line and has significant U.S. sales exposure. Ideally, maybe a smaller publicly traded company. One with less financial flexibility and less brand diversification than Movado.
So you're shorting a less adaptable competitor.
Precisely. This creates our Swiss cheese spread. You're betting on Movado's resilience and diversified strategy to outperform a more exposed, potentially less agile competitor in this tough trade environment. The idea is Movado's playbook: protect margins, protect liquidity positions. It's better to weather the storm than a less adaptable pure play.
Giving you a relatively safer long paired with a potentially more vulnerable short.
That's the concept. It's recognizing that not all watchmakers are created equal when facing a 39% tariff hit to their core market.
Okay, interesting theoretical trade. So to recap our deep dive today, Movado Group delivered a Q2 that, showed an EPS miss, but also showcased a healthy revenue beat and a really strong balance sheet.
Key point, the balance sheet.
All while effectively managing gross margins amidst these new significant U.S. tariffs on Swiss imports. Management's strategic focus seems to be on licensed brand growth, aggressive cost savings, and diligent tariff mitigation.
Plus, that formidable cash position and ongoing capital returns, it provides a sort of cautious, constructive outlook.
And the withdrawal of guidance, we should reiterate, seems to reflect genuine external uncertainty, not necessarily internal operational missteps.
That was the message, yeah.
So we'll be keenly watching policy developments, holiday sales performance, and any updates on their mitigation strategies. Those seem like the key drivers for the company's performance moving forward.
Absolutely. And as always, just a reminder, this briefing is for informational purposes only. It is definitely not financial advice. Please do your own due diligence before making any investment decisions. But I'll leave you with this thought. With global trade policies becoming increasingly volatile, Movado's current challenge, it might actually serve as a blueprint or maybe a cautionary tale for other luxury goods companies. How successfully they pivot their supply chain and brand strategies now, in the face of these tariffs, could very well redefine resilience in the luxury sector for years to come. It's one to watch.
A fascinating case study unfolding. Thank you for tuning in to Talk Tickers, and we look forward to having you join us for our next earnings call briefing.